So let's dive straight in. Roth conversions. Man, I feel like everywhere you go, everywhere, LinkedIn, Facebook, Instagram, YouTube, like Roth conversions is the hot topic right now.
Yep.
So let's break down for people, what is a Roth conversion? And maybe even like not just that. What's the basics of that?
Yeah,
like the foundation.
Yeah, absolutely. So I actually was just going to go into kind of the foundation of what Roth dollars even are, what the different kind of classifications of each type of dollar that someone can have in a retirement account and, you know, a bank account, and how those are kind of all allocated via the tax code.
Perfect. Let's do it.
So first, we'll start with the clear and obvious one, which is Roth. Roth is kind of what I would describe as the superpower dollar, the one that is basically going to be going in to some sort of investment account, usually for retirement, that is going to grow tax-free. Mm-hmm. So you're going to be able to put that money into an account, let it grow over a certain amount of years, and then you're going to be able to pull it out completely tax-free. So it's really kind of that superpower, really awesome, strong dollar that just grows, and there's really no tax penalty associated with it. So we love Roth.
Oh yeah.
We recommend Roth to everyone that we come into contact with.
Yeah, in some form or fashion. Not blanket recommendations.
Not blanket recommendations, right. Obviously, but we really love Roth dollars. Second, I would kind of go into that pre-tax dollar, which is slightly different. Essentially, you can think about it as the taxes on Roth dollars being taken out of that money that you're putting in before it goes into the account. So, for instance, you're going to take your paycheck, for instance. Mm-hmm. You got your paycheck, you get paid. Your taxes are going to get withheld from that paycheck. And then from that balance that's left over, you can take those after-tax dollars and put that into a Roth account or into an after-tax account. Pre-tax is a little bit different. You're actually going to take the dollars from your paycheck. It's going to get deducted before taxes are even drawn out. And then you're going to have a smaller taxable bill. You're going to have a smaller paycheck, essentially, that taxes are actually drawn off of. Mm-hmm. And then those pre-tax dollars, those dollars that you pulled off before the taxes were taken, get thrown into an investment account or a retirement account. Mm-hmm. So the tax treatments are a little different around those. Roth grows tax-free. Pre-tax, you're deferring the taxes until a later date. Mm-hmm. You don't pay taxes up front. It's going to go into the account, grow, and then when you draw those funds out later on, you're going to pay taxes at your ordinary income rate, usually on those dollars.
Yeah. So a simple way that I've heard people talk about before is essentially you can choose to pay the tax on the seed or pay the tax on the harvest, right?
Yep.
And whether you have, one field over here that you're planting or a field over here, ultimately you could net out the same way down the road. But that's where we have different strategies we can look at, like Roth conversions, withdrawal strategies, distribution plans, all that kind of stuff.
For sure.
Thanks for breaking that down. So so the Roth key thing there is the primary reason we love Roth dollars is because it's tax-free growth, right? For most situations, there are a couple of caveats you have to satisfy to get the tax-free growth. But you get that benefit over time. So what is a Roth conversion?
Yeah, Roth conversion really at the simplest core of what it is taking pre-tax money. So for instance, in maybe your employer-sponsored 401k, and you're converting it into Roth dollars. Mm-hmm. Now, the process is really straightforward. You're just taking that money and you're moving it into a Roth account usually. Mm-hmm. And there is a taxable implication there, and that's really kind of the planning piece that comes around Roth conversions. But at its core, it is just taking pre-tax dollars and converting it into Roth dollars. Mm-hmm. So taking that tax deferral down the road, you're going to pay the tax up front to be able to let it go in and grow tax-free for later.
Yeah, perfect. So clarify for everybody here, if we're thinking about doing Roth conversions, because again, it might just be the algorithm. Like it seems like every day 1,000 posts about it. But are Roth conversions always a good idea?
No, I would say not. It definitely depends on your specific situation. Mm-hmm. What we really like to look at Smart Pro, Patrick, is your taxable income in a given year. So, let's just take 2025, for instance. We'll take your income and all of your adjusted gross income for that year. And based on your certain thresholds and your marginal tax bracket, we will adjust accordingly whether Roth conversions are appropriate and in what amount essentially for that year. And we can get into the weeds on that if we want to, but essentially it's really about how much money you make and adjusting the amount that we convert in that year to keep you in a tax rate that's acceptable for you in your situation.
Yeah, I appreciate that. And so the key thing to that point is like it really goes back to what is your income tax rate?
Yep.
And that's where I think a lot of times people get confused or they feel like, oh, here's this strategy and I got to make sure I have all my money in Roth down the road. Yep. You really don't. Yeah. We love that for a lot of reasons. Like Roth dollars, number one, it is tax-free growth. Yep. So if you have a long horizon to let that money grow, it's tax-free. It passes down to your beneficiaries or whoever's going to inherit your assets completely tax-free. Yep. It gives you full flexibility that like when you do in retirement need to buy a car or you have like a $15,000 or $20,000 expense and it's a lump sum. Well, we're in control. Yep. Like we are 100% in control of what our tax implications will be because we've made that decision before to have the freedom and flexibility to take money on our own accord. Yep. One of the things I've heard some other successful advisors say also is that pre-tax dollars are actually an unsecured loan with the IRS because really your ultimate tax implication for pre-tax dollars is based off of whatever the IRS determines your tax rate will be in the future.
Yep.
So it's like if I were to take on a mortgage for 30 years and I start paying on this mortgage, but I'm never told what the interest rate will be. And I'm actually not even told how much the mortgage is, right? Like I just take on this completely black box loan and I have no idea about it, but I know that I have to keep putting money in over time, right? So we don't like that. We want people to be in control. We want people to have flexibility, have freedom, and be able to act accordingly with independence down the road for their future. So thinking about like actually the mechanism of the Roth conversion, we say the primary thing that's going to drive that is your income tax rate at the time of when money's going in and then also the time when money is coming out down the road. We've already said that Roth conversions are not always like there's not 100% guaranteed like always going to work strategy. Every strategy has its pros and cons. We don't let the tax tail wag the dog.
For sure.
Right? If you are in a high tax bracket today and you're going to be in a low tax bracket down the road, we can math that out from a dollars and cents wise that maybe that doesn't work for the tax benefit, but it could work for the flexibility.
Absolutely.
Could work for the inheritance.
Yep.
Could work for freedom down the road, for generational wealth.
Yeah.
All those kind of things.
And I think that that's a really great point. Roth allows ultimate flexibility. And so even if the tax situation doesn't work out for you, if it makes more sense to actually invest pre-tax dollars instead of Roth based on the income that you're making, and obviously we've got the Roth limits for income and what you can actually make. So if you're over the certain threshold for that given year, you actually can't contribute to a traditional Roth IRA. I said traditional and then Roth right back to back to a Roth IRA.
Yeah, right.
So there are a lot of things at play there, but really, like you said, Patrick, it's about flexibility. Roth allows you to control when your money is used, which tax rate, which is 0%, it's used at, and when you can pull it out after 59.5 without penalty. So it really does give you that versatility and that flexibility, and that's why it's so powerful.
Yeah, perfect.